All right, everyone. I'm glad to have everyone coming out, and hope everyone had a wonderful Christmas holidays and wonderful New Year. This year didn't get up to much, just hung out with the family, made it much smaller than normal, but good to move into 2022, hoping that things start to improve with the COVID situation. We can get back to traveling. I know a couple of you saw in the comments you guys are traveling and in the tropics right now. I'm very jealous. It is nice and cold here in Vancouver and quite wet. Find myself making sure I'm wearing really good shoes with good traction right now instead of my standard dress shoes. Anyways, I digress. Topic today is all about what's called the Smith Manoeuvre. I'm going to be talking about whether your mortgage is tax deductible and if there are methods that you can be employing to save yourself some money in tax. And so that's going to be the primary item that will be revolving around today. The Smith Manoeuvre is a really cool thing, and there's a lot of little nuances that I wanted to share with everyone today. So let's get started. Obviously, making sure that we go through a table of contents really quickly, just to give you an idea of what we're going to talk about today. How expensive is a mortgage, saving for your retirement, the difference between good debt and bad debt, using your home equity, what to invest in, the Smith Manoeuvre itself, the tax savings of using it, and what our clients are doing, and how you can learn more. So how much does your mortgage really cost? Let's take a look at a $450,000 mortgage at 1.99% interest on a 25-year amortization and a 44% tax rate. So first of all, you have the interest cost on that. That's $121,000. And this is the principal amount. So keep in mind that you still are borrowing the principal. And in order to earn enough income to cover off the principal and the interest here, and keep in mind the amount of income that you'd have to earn to pay this all back at a 44% tax bracket, you need to earn $1.3 million gross before taxes to pay back that mortgage. And so when you start to look at that, like, geez, a small mortgage of $450,000, I'm going to need to earn a $1.3 million in earned income in order to pay back the interest and principal on that mortgage. It gets a little bit crazy to think about. So one of the challenges that people often face is, what should I do with my money, and whether I should be looking at increasing my investments, or should I just be looking at paying down my mortgage? And the cool thing that I want to talk about is how the Smith Manoeuvre can actually allow you to do both of these things by increasing your investments by paying down your mortgage and utilizing the home equity line of credit feature of the Smith Manoeuvre. The other thing that is very important to understand and recognize too is that many Canadians are woefully prepared for retirement. Many are focused on paying off their home, but only have a fixed income, and so it becomes very challenging for them to pay down that mortgage. One trend that I've noticed year over year is that reverse mortgages are up about 30% every year, and in fact, I think 2021 was probably up actually more like 40%. We're slowly starting to see more and more lenders get into the space of doing reverse mortgages, in fact. And so this is something that I'm noticing is a growing trend. And the problem is that a lot of people just don't have enough money set aside for retirement. The other thing that I want to make sure that we also understand is what the difference between good debt and bad debt is. The whole idea here is that you're trying to minimize the bad debt, and while using but not abusing good debt. And so if we look at this, bad debt would be anything like depreciating assets. So consumer goods, borrowing money to buy a TV, for instance, would be considered bad debt. And good debt is any money borrowed to purchase appreciating assets. So if you're buying real estate or stocks or something like that, these are typically considered good debts whenever you borrow money to buy something that will go up in value over time, not go down. And then, even better, you have tax deductible debt. And this is where, if you are borrowing money to invest, the interest payments or the interest portion of your payments is actually tax deductible. And that's really one of the biggest keys here that you want to look at is, so how can I switch from borrowing money for bad debts and actually switch to good and tax deductible debts by borrowing money against my home to reinvest into the marketplace. And ultimately, at the end of the day, net worth is your end result goal. And I know that it feels really good to pay down that mortgage and eliminate it. And trust me, I'm not there yet. I've got a long runway before I have any of my mortgages paid off. And in fact, because of things like the Smith Maneuver, I don't know if I actually ever will pay off my mortgage. And maybe that's just a millennial thing that we don't expect that we'll ever pay off our mortgages. But the other factor is learning about the Smith Maneuver and other ways of actually borrowing money against your residence at a low cost of borrowing and then investing it into a higher rate of return into another asset class. This is a way of building your net worth. And so if net worth is your goal, then you don't want to be as worried about borrowing money to invest, as long as you expect that you'll be getting a positive return on the investments. So if you borrow money on your line of credit at 3% and reinvest it at 7%, well, your net worth will stay the same because you've increased your debt and you've increased your assets at the same time. But if your assets grow at a faster rate than your debt grows, then your net worth over time will actually increase. So, you do want to look at, your assets versus all of your debts, but overall, it's the overarching net worth that you're really trying to focus on. And the way to do that is using your equity. It's interesting, and we run into this all the time. A lot of our real estate investor clients that are looking at getting started, some of them will come to us and have a home that's fully paid off. Once you have your home paid off, that's a great place to be. And chipping away at that mortgage is something that's quite comforting. But once that's paid off, having that much equity, whether your home is worth $1 million or $2 million, having that much equity tied up in your home is not really working for you. A home fully paid off is not working for you. And so other than the appreciation, there is no gain to having that home fully paid off. And so using your equity in your home is one of the most important things that we preach our clients to at least consider. And sometimes it's a matter of risk tolerance. Some of our clients don't have a high risk tolerance to borrow money to invest. And many of our clients do. And of course, I'm quite biased. A lot of our clients borrow money to invest in real estate or other investment opportunities that earn them a higher rate of return than what their cost of borrowing is. So how do you borrow money against your home in order to invest it? And basically what you're doing is you're borrowing against your home and you're creating a spread on the money. And so in this example here, if you're investing the money at 8% and you're borrowing it against your line of credit at 2.95%, you're creating a spread between the gains of investing the money and the cost of borrowing the money on the line of credit. So in this case, for $100,000 you can access from your home equity, you're actually making 5.05% on that per year, as long as your investment returns continue to earn you 8% and your borrowing is continuing to be at 2.95%. So you're creating a spread of 5.05%, which every $100,000, that's $5,050 per year in money that you're earning without even using any cash or anything like that you have sitting available. It's just accessing your home equity inside your home. Now, the question of, well, what do I do with this money? What should I be investing it in? That's always a big question. And obviously, a lot of our clients do invest in real estate. They buy cash flowing rental properties, or they may be doing flips or buying Airbnbs are very popular right now, for instance. And other opportunities, of course, investing in stocks, investing in growing companies. When COVID first hit, a lot of stocks had dropped significantly, and we actually had a lot of clients go in, redo their mortgages to borrow money, and then invest that into stock market and make a very quick return. And then there's, of course, other investment opportunities as well. So there's private lending, private equities, a lot of different things that you can do with the funds once you've accessed that capital in your home. And again, going back to this chart, you're trying to move away from that bad debt and move into that tax deductible debt. Because whenever you borrow money to invest, the interest portion of the payments is tax deductible. So you're trying to move into this category right here and getting into that good debt part of investing. So the big key and the way to do this is making sure that you've structured your mortgage properly in order to be able to save tax. And so I do want to talk about the magic of the Smith Maneuver. And this was a term coined by Mr. Smith quite a few years ago. I think he wrote a book in the 90s. And then Robinson Smith, his son, actually wrote a follow-up book, and he talked a lot about the Smith Maneuver. In our office, actually, we have a number of copies as we give them out to clients, and it's a really good read that goes into a lot of the details of how this works. But ideally, what the program is really is it's just generating increasing tax deductions monthly as you continue to snowball effect this. And what you're doing is you're paying down your non-tax deductible mortgage debt faster and faster, which then allows you to borrow and invest more money monthly than you were before. And so it is a snowball effect, as what you're doing is you're paying down your mortgage using your extra free cash flow, and then reborrowing that extra amount that you've paid down on the line of credit and on your mortgage, borrowing against your line of credit to invest into other things. And as you generate more cash flow from those investments, you can pay down your mortgage even faster, which then opens up more room available to you to invest even faster. And one of the best parts about this is that it's actually very easy, requires little to no money. So let's talk about how it works. I do want to go into a little bit of details, but what you're doing is all you have to do to do the Smith maneuver is you're just making your mortgage payments, and then you're reborrowing the principal pay down, and then you're investing, and then you're saving the money on your taxes. So let's go through an example here. And by the way, I've seen like all of the formatting on my PowerPoint is all of a sudden acting up. So I'm not sure if that was something where my team were updating a couple of the photos, and it seems like some of the formatting is off. So my apologies for that. I do know how to spell mortgage. Anyways, let's talk about what a typical mortgage is. So this, if you bought a $500,000 home and put 20% down, that'd be $100,000 down on that home. That means you're getting a $400,000 mortgage, and you just have a 400 grand mortgage. None of this mortgage is tax deductible. So this is on your home, then none of it is tax deductible. If you bought a rental property, however, then all of this mortgage that you're getting on the rental property is tax deductible. So if we're assuming that you're buying your own home for $500,000, so yeah, you're probably not buying in BC unless you're buying a condo. This entire mortgage would not be tax deductible. So let's talk about what's called a readvanceable mortgage, however, and this is probably the first step for almost all of our real estate investors or people that just want to invest in general, is to set up a readvanceable mortgage. So this also could be referenced as a HELOC or home equity line of credit. Pretty much all major banks have some form of this. Some are better than others. But what happens in the same example now is you have a $400,000 mortgage on the property, and you start off with a line of credit at $0. But what ends up happening as you're paying down your mortgage, your line of credit limit will slowly increase. And so you always have access to this amount of money that you've paid down on the principal. So if your total mortgage payment was $1,692, let's say, on this mortgage, if $1,031 is principal and $661 is interest, then that principal amount that you've paid down reduces your mortgage balance down. And then what happens is your line of credit limit actually goes up by the same amount. So slowly over time, the money is being transferred over into the line of credit as available equity. The way to think about this product is that you don't get approved for one one mortgage. Instead, what you're doing is you're getting approved for an umbrella of funds. So you're getting approved for a total of, let's say, $400,000, which then allows you to reborrow any of the money that you've paid down, because in both of these, you have a mortgage now for $398,969. Well, that means that you would have up to $400,000 in available credit. So you must have $1,031 available in the principal. And as you pay down that mortgage, the line of credit limit will continue to increase. And then what you do is you take that money available on the line of credit, and then you reborrow that, and then use that to invest. And so now you're reborrowing it and pumping it out the other end to invest. Your readvanceable mortgage, by the way, on the line of credit portion, those are always on a variable rate, and typically most lenders are prime plus 0.5. Right now, prime is 2.45, so your rate would typically be about 2.95%. However, many lenders allow you to have multiple tiers or portions inside of the product. So some lenders allow us to have 5 or even 10 different facilities inside of the product. We can have different mortgage portions and different line of credit portions. So what happens is, you might be paying down your personal mortgage, opening up your line of credit, and then you say, I'm going to invest 100 grand in this investment. You can actually convert that $100,000 line of credit into a mortgage with certain lenders, and now you get a mortgage rate on it instead of a line of credit rate. For illustration, a line of credit might be prime plus 0.5, but a mortgage on a variable rate might be prime minus 1%. And so there's actually 1.5% spread between the mortgage rate and the line of credit rate. However, a line of credit is open, so you can pay it off in full at any point in time with no penalty, and it's also interest only, so it has a lower payment overall. But if you're borrowing the money, usually the example that I use is, if you're going to be borrowing the money for an extended period of time, then put it into the mortgage. If you don't need the money immediately, or if you think you're only going to be borrowing the money for a short period of time, then have it available as a line of credit. So for instance, if we set up a client with a HELOC and they currently have a mortgage of $400,000, but their home is worth $1 million, we might say, okay, we're going to get you a mortgage for $400,000, and behind that, we'll give you another $400,000 on the line of credit. And if you don't have an immediate need for that extra $400,000 in credit, then there's no reason to borrow it on a mortgage right off the bat. Let's just give you a line of credit, because then when you do find an investment and write a check later on, then you can convert that money from the line of credit and lock it into a mortgage term, and then you get a mortgage rate on it. When you do lock it in, you'll be now moving to a 30 or 25-year amortization, which means you're paying down some of the principal, which is good. But on the flip side, keep in mind that your payments overall will be higher than they were when they were interest only on the line of credit. And by the way, I will be answering questions at the very end of the presentation. Any questions you guys have, make sure you put it into the Q&A, and then we'll go through the Q&A at the end. Now, one thing that's really important to make sure that we address too is the use of funds. It's very important that you understand how the CRA looks at what you're using the money for. And if you're using it for consumption, then that's not tax deductible. Okay, but if you're investing with the expectation of generating an income, then the money is tax deductible. I always tell clients, and I'm going to say this on the Zoom, you need to make sure that you speak with an accountant and make sure that you get proper accounting advice whenever you're doing something where you're trying to write off interest on an investment or on your line of credit. But this is the general understanding, is that if you're borrowing money to invest with the expectation of generating income, then the money that you're borrowing is tax deductible. So let's fast forward a little bit. Let's say now that you've got a mortgage that you've paid down from $400,000 down to $225,000. Well, guess what? Now you have $175,000 available on your line of credit, right? And so again, you're paying down that mortgage, and more funds are becoming available on the line of credit. And now you're reborrowing even more money on that. And over time, maybe your entire mortgage has all shifted over to your line of credit, or at least over to this right side, which is your tax deductible side, right? And so over time, you're actually converting your mortgage from a non-tax deductible mortgage to a tax deductible mortgage. And all you're doing is you're paying down your mortgage as you usually would, but now you're reborrowing the money back out on your line of credit and then using that to invest into other things. And so over time, you could actually convert your entire personal non-tax deductible mortgage into a tax deductible mortgage. And how much money do you save when you do that? The answer is a lot. If you look at the actual calculations here based off of a 44% tax rate, which many of you attending this may be at or very close to it. If you look at the amount of interest on this line of credit, on $400,000, it might be about $11,800 per year. And if you're writing off that much interest on your line of credit, you're saving about $5,192 per year in interest costs by borrowing all of this money on your line of credit instead of borrowing on your non-tax deductible mortgage. And keep in mind, you could save money even on the interest cost by having this on a mortgage instead of a line of credit, et cetera. But the point I'm trying to illustrate here is that by shifting the money around and creating more of this being on a tax deductible side instead of not being tax deductible, you're saving yourself a lot of tax. And keep in mind, this is $5,200 per year, not just on a one-time thing. This is a per year savings. This really starts to add up over time. Not to mention you have access to all this extra capital to be investing in, or hopefully earning you more money on the other end too, if you're earning a higher rate of return by having these funds available to invest. And so this is a really important key. I want to paint a quick example for you because it helps to visualize this sometimes too. So I had a client who approached my team, and she was receiving an ICBC settlement, and I think the amount was about $100,000, let's say, for ease of use. I think it was between $80,000 and $100,000. And really simple example, but we looked at that, and most banks or brokers would say, oh, great, $100,000 for your ICBC settlement, that's going to be your down payment, right? And most would say, yes, that's my down payment. So they would take this funds and then use that as your down payment. Here's what we suggested. We suggested, hey, you know what, client, if you take the 100 grand, let's take that and apply it towards your personal mortgage. Let's make a reduction in that and then we'll restructure the mortgage and make sure you have a home equity line of credit attached to it. So now you have a smaller personal non-tax deductible mortgage, and then you're going to have another tax deductible portion, and that will be your down payment for your rental property. And this simple maneuver for this client, her tax rate was probably 30 to 35%. By being able to shift this money over from the high tax bracket, from not being tax deductible to being tax deductible, just on $100,000 in this case, she was saving about $850 or $900 per year in taxes. And this is just a very quick example of how you can sometimes maneuver things. Like if you have a lot of cash sitting aside that you'd like to use to invest in real estate, you'd actually be better served if you still have a personal non-tax deductible mortgage. You'd better served to take that cash, make a lump sum and pay down your personal non-tax deductible mortgage, and then re-borrow the money back out on your line of credit. So you've paid it down, but you've gone back up and you're at square one. You still owe the same amount on your residence, but now you've just converted some of it from being not tax deductible to being tax deductible. And so that's something that is really important to remember and understand. And the tax part of it, of what we do, is become more and more of a larger part of what we do on a day-to-day basis here at Green Mortgage, is just giving people some information on, hey, talk to your accountant, see if this will work. It should, but talk to your accountant, make sure that it works, and then execute on it and save yourself a bunch of money in tax. So let's talk about what our clients are doing right now. One of the things that we're finding is a lot of our clients are reducing their payments and paying their high interest debts off by refinancing. We're doing a lot of debt consolidation right now for clients that have gone through, especially people that have gone through COVID and wanted to hunker down and say, you know what, I'm okay, I'm going to be fine, I'm going to get through this. We've been working with a lot of our clients just to reduce their payments and paying off their high interest debts by restructuring and refinancing their mortgage. And so it's an absolute, almost always a no-brainer. If you're borrowing money on credit cards and unsecured lines of credit, especially if the amount is at least $50,000 or more, it almost always makes sense for you to redo your mortgage, almost always. The only examples where it may not make sense is if your mortgage penalty is extremely high to break that mortgage. And even then, you might be seeing that your mortgage costs might go up slightly, but if you're paying off really high interest rate debts, it almost always makes sense. And so if you are carrying some balances on your balance sheet, so if you have some credit cards or lines of credit, et cetera, that need to be paid off, then that's something you should definitely be reaching out to our team to investigate and learn more about. A lot of our clients are trying to learn more about how the Smith Manoeuvre can be used to save them thousands of dollars in tax with very simple changes. And so this is one of the things that we always advise our clients on is, hey, if you're looking at buying a rental property, let's figure out where the down payment is and should be coming from. We like to say that we're not an order taker, meaning that we don't just do exactly what the clients tell us to do necessarily. If we think that, hey, maybe we should give some advice or some input on, I know you're telling me that you want to use cash for your down payment, but maybe we should reconsider using that to pay down your mortgage, and we can actually save you $800 a year in taxes by doing this little maneuver. And it doesn't always make sense for the clients, but in many cases it does. So the Smith Manoeuvre is a really cool tool, and we do educate clients on this very frequently. In fact, a couple of our agents in our office are Smith Manoeuvre certified, so they actually went through a course to learn more about the Smith Manoeuvre and make sure that we're very well equipped to answer in-depth questions, as there's a lot to learn about the Smith Manoeuvre. We've also found that, especially in the last couple of years, home values in across Canada have skyrocketed, and a lot of our clients now are looking at trying to access that capital in their home to reinvest, and then just creating a spread on the cost of borrowing versus the return that they're getting on their home equity. So we're finding a lot of clients are doing that right now. That's a big trend that we're seeing. And so if you're interested, and that's one of your goals and objectives, January 2022, everybody has goals and objectives, which probably start to disappear in the next couple of weeks, especially if it's a diet and exercise goal. I know, I know that's what happens. But if you guys have goals and ambitions of buying a rental property this year, or you want to increase your investments or grow your net worth, then starting off with this is one of the best spots. You always want to figure out where is my capital going to come from and get that settled and done and pushed out of the way first. Restructure things, get that all done, and then you can start to look at, okay, now that I have that money available to me, now what should I do to invest the money? And then the other thing, of course, when we do this day in, day out is helping clients utilize their home equity to buy rental properties. So that's something that we're doing all the time. Now, there's also something called a few different items here, and they're called accelerators, but there's a few different ways that you can actually accelerate this process of paying down your mortgage and reborrowing the money back out and utilizing this within your home equity line of credit to save money in tax. There's the debt swap accelerator, which is basically a debt consolidation situation. There's also a cash flow diversion accelerator, a drip accelerator, and prime the pump and cash flow dam accelerator. I don't have time to go into all of these details, and they are actually contained in Robinson's book, which by the way, I don't know how many copies I have at the office, but however many I have, I'm happy to give them away. Anybody that emails us at info@greenmortgageteam.ca, I'll make sure that we pop a copy of this book in the mail, and just make sure that you send us a request for the book and also your mailing address so that we can send you over the book. Also, if you don't have a copy of my book, Rockstar Real Estate Investing, I'm also happy to pop that in the mail for you too, which is a good book to read about the fundamentals of investing in real estate. But one thing I do want to talk about on the accelerators is the cash flow dam accelerator. And so one of the interesting things that I'll touch on is that technically you can actually use the Smith Manoeuvre to accelerate and snowball even faster than what I was explaining, because you can actually, if you have rental properties, you can take the rent from your rental properties and use that rent to pay down your non-tax deductible personal mortgage, which opens up the room on the line of credit, and then that line of credit can be used to actually pay for your mortgage payments. Now, the problem is that it's a bit administratively intensive because most lenders will not allow you to make a mortgage payment from a line of credit account. However, you can use this to accelerate things if you're willing to do some moving around of money every single month and slide things around, because now you're paying off your mortgage even faster because you're taking the rent checks and paying down your personal non-tax deductible mortgage. And then on the flip side, you're increasing that tax deductible debt even faster because all of the mortgage payments and all of the expenses on the rental properties are going onto the line of credit immediately. So it's a really cool way of accelerating things and moving along a little bit faster. So I won't go into too much detail about these different items because they are contained in the book. And frankly, if you want to do it right, then you should read the book and learn how you can do it properly. One thing that you can also do too is you can visit our website. There's a Smith Manoeuvre calculator. Our website also, the Smith Manoeuvre website also has their own calculator on their site too. If you wanted to really dive into it, there's also a Smith Manoeuvre course that you can take that will help educate you and teach you more about investing in real estate and using the Smith Manoeuvre to accelerate things. We do have upcoming webinars as well, by the way. We have a webinar series that's always the first Wednesday of every month at 7 p.m. And like clockwork, even if I'm on holidays or on vacation, yes, I tell my fiance, honey, I got to do this because consistency is key. So even if I'm away somewhere hot in the tropics, soaking up 30-degree sun, I will still be doing these webinars just to try and make sure that everything's consistent. When the next one that I have actually coming up next month is about investing in real estate and how your typical real estate deal typically is looking at about a 20% plus return investing in real estate. And I want to talk about the returns in investing in real estate and some of the basics of how to do it. Later on in the year, I think in either April and May or May and June, I'll actually be talking about how to buy your first 5 properties and then how to buy 6+ properties as well, because there are different strategies and styles with regards to how to do that. So it's time to get your retirement strategy in place. If you wanted to learn more about how you can employ the Smith Manoeuvre, then feel free to book a consult with us today, and we can talk a little bit more about what the parameters are, how much money you qualify for, what kind of rates and terms you can be looking at. As I mentioned earlier, I do have some copies of the Smith Manoeuvre book at my office, and I'm happy to send these out to those that are interested. And also, for those of you that don't already have a copy of my book, we became a Amazon bestseller a couple of years ago when we launched our book called Rockstar Real Estate Investing. So it talks a lot about the fundamentals, and then near the end of the book, also talk a little bit about some of the more advanced techniques. And it's very easy to read. We tried to make sure that it's a very easy read, especially especially for those of you that are first venturing into this. I tried to make it not too mortgage broker lingo and too technical. So really tried to give you the good fundamentals in an easy to digest format. So if you have any questions, feel free to reach us. This is our office. It's downtown Vancouver at Pender and Howe. You can also visit our website at greenmortgageteam.ca. By the way, all of the recordings of previous webinars are available on our website if you'd like to watch them. Last year we did 11 webinars. That was our first year that we started doing these webinars on a monthly basis. And this year we already have our schedule mapped out for the entire year. So if you have any questions that you'd like to direct to our team, info@greenmortgageteam.ca, or phone number is 604-229-5515. So I do have some questions for the Q&A. So what I'll do is I will stop screen share, and I will open up the Q&A now and answer some questions. So Armand is asking, does readvanceable mortgages, are they available at the banks? And so yes, in fact, most of the best products for readvanceable mortgages are available just with the banks. So as a mortgage broker, we deal with about 40 different lenders and to find the best rate and best product. But actually, for HELOC products, major banks tend to have the best products for that. Not always the best rate, but usually the best product. So a product that is automatically readvanceable, and meaning that as you pay on the mortgage, the line of credit will inch up, and number one. And then number two, allowing you to have different segments or portions inside of it. That's another thing that the banks tend to do better than non-bank lenders. Some of the non-bank lenders that we deal with, like MCAP, for instance, or CMLS, credit unions, a lot of time those lines of credit are static. So you have one mortgage and then one line of credit, but as you pay down the mortgage, the line of credit limit does not increase. Sometimes those lenders, however, might have a better rate, and so you might want to consider that, especially if you're getting starting off and you don't need access to all of that extra capital. Some of our clients will opt to get a lower interest rate on the mortgage, and then the line of credit is static, meaning you don't access extra capital as you pay down that mortgage. Todd has a question. So just in case it doesn't get covered, how does this activity using your line of credit affect your credit score? Good question, Todd. So it's a complex algorithm that Equifax and TransUnion use. And so those are the two credit reporting agencies in Canada. And what they do is they look at how much credit do you have available and how much are you borrowing on said credit. The key that you want to watch out for is you want to try not to bump up against the maximum amount that you're borrowing all the time. On a mortgage, it's not as concerning because it's not revolving credit. But if you do have a massive credit line for $400,000 and you're maxing it out, then it will have an inverse effect on your credit. However, if that's the only thing negatively impacting your credit and all other pieces of credit are in good standing and at low balances, and you're making all of your payments on time, then your credit score might not be a 900, it might be an 850 or an 820, but guess what? You're higher and above the minimum required credit score to qualify for the best products anyways. So in general, as long as that's the only negative impact you have in your credit rating, you should be okay. But if you're maxing out there and you're maxing out in other areas, then maybe maxing out a line of credit may be a challenge for you. Shahela has another question. Can you get a HELOC on a mortgage that has 3 people on it? So some banks only allow 2 borrowers. Some lenders will allow more, up to 4 borrowers. So it does depend on the bank. So we do have some banks that will allow for that. But it is important to note that not all banks will allow you to have 3. For instance, Scotiabank only allows for you to have 2 borrowers on the HELOC. Stefan has a question. If you use money in your line of credit for stocks, you can still write off the interest. So in general, the answer would be yes. So if you're investing in stocks with the intention of earning income by making that investment, then you should be able to write off the money. So it's not just investing in real estate. You can also invest in other investments like stocks. Todd is asking, if you get a bonus, would it be better to leave it in RSP or take it out, pay the tax, and put the rest on your personal mortgage? Probably, I'd have to look at some more numbers there, Todd, but in most cases, if the money from a bonus is already going right into the RSP, probably best to leave the money in the RSP, because now you have to pay tax to take the money out. It is good to keep in mind that you should have some balance in your portfolio. I mean, it's great to take as much cash as you can and pay down the mortgage, but sometimes it just makes sense to have some money going into other things like RSPs, et cetera. And so that's something to consider. So my answer to that is probably not, but I'd have to take a look at it. Terrence's question, CRA's rule allow interest to be deducted from loans with an expectation of generating income. Does it matter if the loan is issued from an institution from within Canada? I don't know that answer, actually. I don't think I've ever run into this this question. That's a good question, Terrence. The reality is it's unlikely that a lender from outside of Canada would lend money to you in Canada. In general, it would be an institution located within Canada that is lending inside of Canada because of Canadian law and regulations. I don't see, for instance, a U.S. mortgage company deciding to do Canadian mortgages unless they were a registered Canadian entity. So I don't know the answer to that, but I also don't think that's likely to come up or highly likely. Alden has the question, how does the readvanceable mortgage with the Smith Manoeuvre affect your debt to service ratio? Good question. So depending on the lender, most lenders will look at your line of credit limit as if you were borrowing all of it when you go to qualify for subsequent financing. Some lenders only look at the line of credit balance, so the amount that you have owing on the line of credit when you go get subsequent financing. So it is important to note that if you get a really big HELOC on your residence, it might start to drag you down and drag down options for you to purchase subsequent properties, because some lenders are going to look at that massive limit and say, well, now that you have $1 million available to you in your line of credit, we have to assume that you may borrow all of that. Honestly, it is very confusing that the lenders treat it that way when if a client has really good credit and great income, et cetera, and they don't treat unsecured lines of credit or credit cards in the same manner. You could have $100,000 available to you on unsecured credit, and they don't care about that. But some lenders will still look at the line of credit limit and assume that you're going to borrow all of it, even if your credit rating is very good. So it's kind of an odd thing. So we know which lenders are going to consider that line of credit limit versus some lenders are going to only consider the line of credit balance. On the flip side, if you've got a massive line of credit and it's negatively impacting your ability to borrow money on your next deal, well, guess what? The amount that it's negatively impacting you by is the amount of that credit you have. And so if now you only qualify for a smaller mortgage on the next purchase, well, just maybe you have to increase the money that you're borrowing against that line of credit, because the bank is assuming that you're borrowing all of that money in the line of credit anyways. So if you decide to actually pull money out for the down payment, that's not actually negatively impacting your debt servicing at all in that case. So again, that's where we can help you. It is, this is something we have to have a bit of planning and foresight to say, if we get you this big line of credit, let's make sure that we know, which lenders you could qualify with on a upcoming purchase. Alan is asking, does your mortgage brokerage cover on Ontario too? And so, yeah, so we were able to do mortgages in Ontario. Reach out to us and we'd be happy to help you with that. Is it possible to get emails for your next webinars? Absolutely. Yeah, if you send an email to info@greenmortgageteam.ca, we'll make sure that we put you into our upcoming webinars, and we'll be happy to send you the upcoming ones. Next question, how does a line of credit on a Smith Manoeuvre affect your borrowing power in the future? So I just mentioned that. Hopefully that answers your question. Number two, can you also do a Smith Manoeuvre on your rental property, or does it only apply to primary residence? So you can also do a HELOC or home equity line of credit on a rental as well. The benefit is not as good, however, because all of the money that you're borrowing against your rental property is going to be tax deductible as long as you're borrowing the money to invest. However, the nice benefit is you can still get a HELOC on a rental. As you pay down that mortgage, you can reborrow that extra little bit and then use that to invest in the future. And so it still is beneficial for you to get this type of product available on a rental property, although you're likely, as long as you're always borrowing money against that property to invest, you're likely to always be in a situation where all of that money is tax deductible anyways. Olivia has a question. Is it a good idea to switch when we just bought a home, or should we just wait to pay a bit more on the mortgage? It depends. You'd want to take a look at your situation and see, okay, well, how much do I owe on the mortgage right now? What mortgage rate do I have? It's possible, depending on when you got that mortgage, the rate that you have could be higher or lower than current market rates, so that could have a factor. Also, if you bought with 5% down, let's say 3 months ago, you probably don't have enough equity in the home yet. You have to have a minimum of 20% equity in the home before you can have this type of product, because you can only get a maximum of 80% leverage or financing against a home for a readvanceable mortgage. And so you have to keep that in mind. If you bought the home a year ago for $500,000 and put 5% down, the value of the property would have to have risen enough, or you've paid down your mortgage enough, where you're now only borrowing 80% of the current value. So that's something that we'd have to take a look at. Nolan has the question, what comes first? Conversation with the accountant to talk about the mortgage strategy, or a conversation with someone like yourself, a mortgage broker? Maybe I'm biased, Nolan, but it helps to have, from our perspective, a lot of the time, we are the ones that open and close doors. And so you may not want to have a conversation with your accountant and say, hey, I'm thinking about buying this $1 million property. I want to do this, I want to do that. And then only to find out that after the whole conversation with the accountant, the mortgage broker says, hey, you can't qualify for that $1 million property. You're going to have to reduce it down to 500,000, right? So often it's good to talk to the mortgage broker just to narrow your focus. You know exactly what you can do and what you cannot do. And then you can go to your accountant and say, hey, I have an idea of what I'd like to do and what I can actually qualify for. Now, does it make sense? Also, the mortgage broker may be able to give you some input on how to structure things. And you can always relay it back and forth with your accountant as well. I know that with our office, we deal with a lot of accountants. It's very frequent for us to actually have a conversation with you and your accountant to figure out, hey, how do we structure things? How can we get this done? Question, thanks for the wonderful presentation. Thank you. My question is how to apply the Smith Maneuver in the year of renewing your home mortgage. For example, do you apply for a minimum mortgage by putting it all in cash and then refinance to take the money out to invest? Yeah, so I'll rephrase that. So if you have a mortgage coming up for renewal this year, let's say, and it's $300,000, but you have $200,000 in cash, I recommend that what we would do is we would restructure it. So when your renewal comes up, as it's approaching, we say, let's redo your mortgage for $100,000. We're going to be applying that $200,000 in cash to limit and pay down your mortgage. And we're going to give you a $100,000 mortgage and then a line of credit for as much as we can qualify you for on that renewal. And then you can reborrow the money back out in the line of credit and then reinvest that money back out into something else if you wanted to. When your renewal is coming up is a wonderful time to be looking at whether you should be increasing your line of credit limit or restructuring things to better serve the Smith Maneuver game plan. Lauren has a question. Do you have any recommendations for accountants who are experienced with Smith Maneuver and working with real estate investors? Of course we do. So Lauren, if you send us an email, we have different accountants in different locations. And so if you just tell us a little bit about yourself, we'd be happy to do an introduction with the accountant that we know and trust and somebody that's familiar with the Smith Maneuver. Right, Simon has a question. How do you prove to the CRA that you're using your HELOC for investments? The CRA, if they audit you, will ask you for a paper trail. So it's really important that you keep a paper trail of, hey, I borrowed this money and then I used it for this purpose. I borrowed it and then I invested it in this. And so you should be able to follow the money and follow the paper trail. So that's something that you'd need to be able to exemplify to keep them happy. David has a question. How do you service the HELOC if you invest in a negative cash flow investment property? Well, it really comes down to what your personal income is in that situation. Sometimes we have borrowers that are very strong, have very high incomes, and they're able to cover off a negative cash flow in an investment property. Keep in mind, you have to have a really good income for that because in general, lenders only use about 50 to 80% of the rental income to qualify you when you're looking at a rental property. And so if it's negative to you, it's going to be really negative to the bank, and you have to have a really high income to cover off that shortfall. So that can be a challenge, but at the end of the day, there are ways that you can still get that done. It just really comes down to how negative cash flow is that property, but also how strong is the borrower. Some of these you just need a stronger borrower to offset what might be a weaker property. On top of that too, using the right lenders is important because some lenders use a higher percentage of the rent. We actually have some lenders that use up to 100% of the rental income, which is almost unheard of. And frankly, it's a lender that's rather obscure. And I think I'm one of the only brokers that really uses that bank a lot. And the reason for that is they have just really good rental policies. So they're really slow. They ask for a lot of documents, but they get our deals done. So comes down to strength of borrower, how negative it is, and also which lender we're going to get that done. Lauren is asking, have you ever found institutions hesitant to fund mortgages in New Brunswick or limiting how many properties you can have in a certain area? New Brunswick, not necessarily. We don't really have I don't recall any lenders anyways coming up and saying, hey, we don't want to lend to you more than this many properties in New Brunswick. We have had some situations where some lenders, like not too long ago, we had a major bank that said, if a client has more than 3 rental properties in Alberta, we don't want to lend more properties in Alberta to that customer. And that was primarily when COVID hit. Alberta was one of the provinces that got hit hardest at that particular time, and so they pulled back a little bit. So that's something that you need to be watchful of. Another thing that you need to be careful of is that lenders often have a max of 5. And so that is either 5 total properties, so that's titles. So if it's a duplex, that's often 1 title. But 5 properties max with them, or in total. So you have to be careful of that. Sometimes they'll say, well, we'll allow only 5 in total, or you can have more, you can have up to 10 as long as no more than 5 are with us. So you have to be watchful of that. Most lenders do have some kind of caps or limits on the number of properties you can have with them. Georgina asks, are all Scotiabank HELOCs readvanceable, or do you have to specifically arrange for the balance to increase? So there is, there's a little a trigger that you can ask the branch to do, and it's called ALI, auto limit increase. And if that is triggered and set, then as you pay down the mortgage, the line of credit limit will increase. Now, Scotia typically, as long as you're, you have a good credit rating within their branch, and they have a letter grade system, they don't typically ask for new income documents or any other further documentation to increase that line of credit limit. They typically just auto approve it, as long as your step, which is a Scotia total equity plan, as long as that total available amount is giving you available credit, you can increase your line of credit without having to supply additional documents or go through any other due diligence like appraisals and whatnot. So that being said, though, if you do ALI, then it can trigger so that it's automatic, whereas you paid on the mortgage, the line of credit limit automatically increase on a monthly basis. Scott, where can we find the specific course that you have your agents take for the Smith Manoeuvre? So I think it's Smithman. I think it's smithman.net. Let me just check here. Smithman.net. Yeah, smithman.net, and I'll put this into the chat for everyone. .net. All right. Next, Lauren is asking, do you work with the Maritimes as well? So Maritimes is the challenge. The Maritimes is about 5 hours or 4 hours ahead. So usually we have a broker partner that we deal with out in the Maritimes that we usually refer our clients to. So with regards to the Maritimes, we usually have a referral partner out there. Occasionally we will do deals out there depending on the deal. Especially if it's commercial, then we like if it's a large multifamily building or something like that, then we'll often do that. But most of the time we have a partner that we refer our clients over to that also works with a lot of investors. Aaron has a question. Do you have a tool to roughly quantify the benefits of putting 100 grand into a HELOC versus investing it outright? I asked my accountant, he thought it was a matter of choosing to pay the bank versus the government. So I guess investing it outright, non-Smith, so just using cash. Well, the reality is if you use the cash to pay down your non-tax deductible personal mortgage, and then you reborrow the money back out in the line of credit, now you've reduced your debt cost on this side and increased them on the other side. You're still borrowing the same amount of money in total, except now you have a tax deduction. So Aaron, I would disagree with your accountant on this one. There may be something additional or extra to that conversation. I'm sure that somebody on my team would be happy to explain and discuss it with your accountant to see if maybe there's something that we're missing or maybe not have been factored into this this advice that had been given to you. But in general, if you're borrowing the money, if you're using your cash to pay down your non-tax deductible mortgage and then reborrowing it back out, then it would make sense. If he's saying, well, if you've got the cash over here and you just borrow extra money against your line of credit to invest, what's better? Well, you now are borrowing more debt in that case because you haven't used your cash to pay down your non-tax deductible mortgage portion. So in that case, then maybe it wouldn't make sense. But I think in the example, you're taking the cash and actually paying down your non-tax deductible mortgage. If you have then non-tax deductible mortgage outstanding, then it should make sense in general. Simon has a question. I converted a portion of my HELOC to a mortgage. I'm looking to reapply and tap a higher HELOC due to the latest higher appraisal. What's the process for that? So if you're wanting to reach out to our team, email us at info@greenmortgageteam.ca, and somebody would be happy to jump on that and have a conversation with you, likely tomorrow, to discuss your options. You'd go through an application process, and so we would be asking you some questions about your current situation, what the value of your home is, and how much money you have owing on your current property. You can go up to 80% of the property value, assuming that you qualify to do so. And in general, it takes a couple of days to gather up all the documents necessary. Then we go over the options with you, let you know which lenders, what rates, terms, etc., and then submit it to the lender. And in general, the lenders take anywhere from 2 business days to 10 business days, depending on which lender it is, to get the approval back. And then once they give you the approval, you usually need to wrap up a couple of documents and then send it to a notary or lawyer. Front to back, minimum usually about 3 weeks to fund a refinance. Sometimes it can take 4 or 5 weeks. Sometimes in the summer months, some refinances, because there's so many purchases going on, just keep getting pushed to the back burner, and so it can take longer in the summer months. That's one of the reasons I actually I'm speaking about the Smith Manoeuvre today, because turnaround times are much faster to get these refinances done today than they will be if you wait until the summertime, when the lenders all get really busy, and it's very painful, to be honest. Some lenders take 6-8 weeks. We had some lenders taking 3 to 4 months just to pick up a file during COVID if it was a refinance. So better to start earlier. Deborah is asking, do you know of a good real estate accountant? I do. Yeah, send us an email and we'd be happy to do an introduction to a good real estate accountant. Todd has a question. Oh, another question about a Smith Manoeuvre accountant, or actually it's Linda. Hi, Linda. Yes, we do. So send us an email and we'll be happy to introduce you. Eric has the question, do you have access to private lenders as well, and what range of rates for first and second mortgage? So private lending is completely different. So to give everybody an understanding what private lending is, you have A lending, which is major banks, credit unions, and non-bank lenders that mortgage brokers have access to. Then you have something called B lenders. And so B lenders are lenders where maybe the client has slightly worse credit, maybe their income is a bit trickier, maybe they're self-employed, and B lenders will do those types of deals at a slightly higher interest rate. And then you have private lenders where they are really real estate focused. And so essentially you go from A to B to private. And as you move across the spectrum, you move away from being client focused and looking at the client strength to making the decision. And you move more into the property focus being the strength of the application. So private lenders really are not as concerned with the borrower. They just want to know what the exit strategy is and what the story is. They're more focused on what are we lending on and how much are we lending on it. That's the major key for private lenders. So when it comes to quoting rates for private, if you look at what are we lending on and how much are we lending on it, that risk factor goes up whenever you're lending on a property that's in a smaller market. So if it's less marketable is the term that's often used. If it's a house in Vancouver and you're borrowing 50% of the value of the home, we're seeing rates that are up below 5% actually, which is very cheap for private money. If you're looking at a second mortgage in a small town where the population is 2,000 people and you want 80% of the value, where you're probably paying 15% for that money. So there's a pretty big range there. Most first mortgages between 50 to 70% loan to value are probably getting priced between 5 to 7.5%. Second mortgages in that same range are probably getting priced at those same rates plus about 2%. So probably about 7 to 9% is kind of the standard pricing, but it depends on where the deal is and what the property is, how much money you're borrowing, etc. Eldon has a question. Hi, Eldon. how does self-employment versus T4 income affect a lender's view of how much a borrower would qualify for? So as long as it's taxable income, so whatever your money you're taking home and paying personal income tax on is the number that they can use. There are some special programs where you can help a self-employed borrower use a higher income. There's some things called corporate net income or stated income that allow you to boost that number. But if you pay yourself a T4 income from your corporation or a dividend from your corporation, if you're incorporated, or if you're sole proprietor, after your write-offs, whatever number is your net income, whatever those numbers are, the lenders are using that. And that would be the same as if you were a T4 employee, for instance. So the number would be the same. But the biggest challenge for most self-employed borrowers is that number that they pay themselves is usually less than what they would be receiving if they were an employee of a separate third-party entity. So there are some challenges sometimes with that. But they're just looking for what's called the line 150. So that's whatever your T4 and dividend income is if you're incorporated, or if you're a sole proprietor, then it's whatever the net income is on your tax return. If you use the line of credit to private lend for real estate investing, will that be tax deductible too? So yes, if you're borrowing money to lend out to other people and you're earning an income on that investment, then that is another way to do that. In fact, we have a lot of clients that have borrowed money against their real estate portfolios to then lend out in private lending. And so I was just talking about how the private lending rates might be anywhere from 5% to 7.5%. Even the lowest possible risk private lending of lending 50% of the value of a home in Vancouver, let's say, earning you 5% is still a higher rate of return than the cost of borrowing that same amount of money on your line of credit. And so a lot of our clients do borrow money against their portfolio and then invest and basically park that money into private lending. So very common. Linda, I haven't heard about what lenders would lend on Airbnbs. It seems to have to be paid in cash. Also, what options do you suggest for someone with cash with a low credit score of 670? So a score of 670 isn't that bad. Some lenders do like to see a 680, and so often lenders like to see 680 and plus. You're not that far off if you're at 670. So it's just a matter of just making sure that you look at making sure you're not borrowing more than about 50 to 70% of your credit. Basically, the more highly utilized your credit is, the worse your credit score will drop. And the basic thing is just making sure your payments are on time every single month. That's the number one thing to do. The other thing you can be careful of if you're right below the threshold is trying not to have too many inquiries. If we're talking to a client and they're like, we're right around the border, often we'll say, hey, look, go pay $30 and get your own credit inquiry from Equifax and send that to us. We'll take a look at it before we do one more poll. Because if you're really close, then let's just see and make sure that you're on track here before we do a poll. But at some point, if you're applying for a mortgage, the creditor would have to pull it. And so we would have to pull a credit report if you're wanting to go and submit an application. Airbnbs, that's an interesting one. It is very difficult to finance Airbnbs, absolutely. So difficult, in fact, that I have a webinar coming up in a couple of months all about financing Airbnbs. I can't remember if it's the March one or the April one, but I think it's April. I'll be talking about how to finance Airbnbs because it is tricky. There are some ways of doing that. In general, an Airbnb is easiest to finance if it's considered what's called a second home or a vacation home. If there's no rental income required from the property in order for you to qualify for that mortgage, then that often is the easiest way of structuring that mortgage. That often comes down to there's a number of different things we'd have to look at, Linda, for that. But in general, financing Airbnbs can be tricky for sure. Charlene, if you use a HELOC for down payment, are lenders okay with that? Or should you move it into savings? You can use a HELOC for down payment. There's a very short period of time during COVID where one bank in particular came out with a weird rule and they said, we're not going to allow people to use a HELOC for down payment. So we had to get clients to take the money out of the HELOC, stick it into the bank account, wait and let it sit there for a couple of months, and then we could use it for down payment, which is the silliest thing ever. But banks are okay with you borrowing money against assets for investing in or for down payment. Where it's trickier is if it's an unsecured line of credit because you're borrowing against something that you don't own, because it's unsecured, that's usually where you get into a tricky situation. So a home equity line of credit is real estate backed. That is okay, and that's a valid source of down payment. Helen has a question. If I refinance my primary residence, increase the HELOC, will it affect my borrowing ability for next rental property? So yes, Helen, it will. As I mentioned earlier, but I know that you attended a bit late, the line of credit limit with most lenders, they will look at the limit, not the balance, to determine the maximum borrowing power that you have. Not every lender does this though. So there's a few lenders that only look at the balance owing on the line of credit, not the line of credit limit, when determining how much money you qualify for on a subsequent deal. So that's something where we're very familiar with which lenders look at the balances and which lenders look at just the limits. Jewel, great presentation, Kyle. Thank you. Does TD have the same policies regarding attaching a HELOC to a mortgage without further paperwork and assessment? So TD's flex line is in nature, actually. It's just an automatically readvanceable product, and so it's not like the Scotia step where you'd have to do that. You got to be careful though, because a lot of the times TD will just do a mortgage and then a line of credit behind it that is static and is not connected, meaning that as you paid in the mortgage, the line of credit limit does not increase. You need to make sure that you're getting the FlexLine product in order to have that readvanceable feature. Sean has a question. Thanks for the webinar. Very informative. Thank you. Question: how will my rental property income affect my mortgage renewal, assuming I need to requalify? Do they see I make X amount, salary plus rental income, or they treat the rental income as risky and therefore not as beneficial as if the money was fully salary? So first of all, on just a straight renewal, if you're just renewing your mortgage, the lenders don't redo your, they don't look at your qualifications again, which is great. So if you go out and buy a property, they're not going, you don't have to worry about your financial picture changing and then your renewal coming up, and then now all of a sudden you don't qualify for that mortgage. There was actually some talk about the government wanting the banks to start to do that and re-qualify clients in renewal, and the banks and us as brokers were pushing back, like, this is going to have a domino effect. There's a lot of people, because they keep getting, the policies keep getting tighter and tighter and tighter as time has gone on. If people have to re-qualify when they got a mortgage back here, when the qualifications were much better before the stress test and before these other things, now all of a sudden a lot of people don't qualify for the mortgage that they already have. That could create a systemic problem where all of a sudden tons of people can't afford their mortgage, can't renew their mortgage, and then all of a sudden domino effect and real estate values could tumble. So they decided not to do that, which is very good. Now on the rental income part of it, because the lenders only use about 50 to 80% of the rental income in general, usually it's better for that to just be straight income. The only consideration here is that there's actually a couple of different methods of treating rental income. There's something called an add to income method, which is meaning that they just take whatever the rents are and then add it to your income. In fact, that method is actually worse for you, Sean, because when they do this, they look at what percentage of your income is being used towards all of your debts, and they don't want more than 44% of your income to be used towards all of your debts. So the problem is any income that gets added to your income, only 44% of it is actually being used. The standard method that most banks have for qualifying rental properties is they take 50% of the rent, add it to your income, but then they only want to use 44% of that income towards qualifying. So if you had $1,000 a month in rent, they take 50%, so 500, add it to your income, and then only 44% of the $500 would be used. So about $220 a month in income is being used, which is not qualifying you for much. And so the better method is what's called an offset, which means that they would say, okay, if there's $1,000 a month in rent, if the lender's going to use, let's say, an 80% offset, then they would use 80% of that rental income and offset all of the expenses against it first. And whatever's left over is either a surplus income on your file or it's a small liability. And so usually an offset is better. So the long answer is it depends based on the lender's guidelines. But the good news is you won't have to worry about requalifying in your renewal unless you want to add money to it. So if you want to set up a bigger line of credit or get a Smith Manoeuvre product set up, then you would have to go through the application process. And that's sometimes where we'll look at, hey, Sean, over here, you can qualify for a better rate, but less money. Or if you go over here to this lender, we can get you more money. Maybe the rate's 0.1 or 0.2% higher. But if you have access to an extra 200 grand and you invested at 10%, you're going to make an extra 20 grand a year by having access to all this extra capital. Well, you're going to make way more money than paying an extra 0.2% on your mortgage, on a $300,000 mortgage, let's say, which would be $600 a year. So that's another thing that's important, is access to capital. Something's going to be more important than what the interest rate on the mortgage is, especially if it's a large sum of money. A question from Emad. I bought a new house for $470,000 8 months ago, and the builder is selling the same at $590,000. Do you think it's a good idea to apply for HELOC? So it depends on what your down payment was, Emad. If you put 5% down, then you're probably looking at having a mortgage right now of about $450,000. If the current properties are selling for $600,000, 80% of $600,000 is $480,000. And so if you currently owe $450,000 and 80% of the current property value is about $480,000, then you could access about $30,000 possibly by redoing the mortgage. So that may or may not be enough money for it to be worth it. Hopefully, if you look at what mortgage you took 8 months ago, if it was a fixed rate, fixed rates have gone up. If it was a variable rate, variable rates have gotten slightly more competitive in the last 8 months. And so it may make sense if you're in a variable rate to redo the mortgage, because you'll save money on the interest rate and also get access to some more capital. But if it was a fixed rate mortgage that you're in, it may not make sense to break the mortgage, pay the penalty, take a higher interest rate, and do all of that just to get access to 30 grand. It might be better to just wait for a little bit. Maybe you're going to wait until the renewal. Or if you put more money down than 5%, then maybe you have access to more capital right off the bat. So just keep that in mind. The amount of capital you could get, Emad, would be about $480,000 minus whatever your current mortgage balance is, because 80% of the about $600,000 is $480,000. That would be your maximum mortgage plus line of credit. Brad has a question, and I hope he doesn't play hockey, because if it's Brad Marchand, the hockey player, then I do not want to answer this question. For all of you Canucks fans out there, you know what I'm talking about. Brad, can you borrow from a HELOC to buy or build a carriage home on your property as a rental? This is a more complex question, because if you start claiming it as a rental and start claiming the tax deduction, then you would have a taxable capital gain on the increase to the value of the carriage home on your property. So I think there's some taxation things that are going to interfere here a little bit. In that case, Brad, I think you need to talk to your accountant and figure it out, because you probably would write off the interest portion of the payments on this, but then you're going to be paying capital gains on the appreciation of that part of your personal residence. And so you're going to save some money in tax on one side and then pay more in tax on the other side. So something for you to talk to your accountant about. Eldon asks, should one purchase property within a corporation to take advantage of a higher revenue than one might show personally? So the reality is, if you're buying rental properties and it's residential real estate, then the lender's always looking at the personal income of yourself and not the corporation. However, there are some special programs called corporate net income, where if your corporation made a lot of money in the last couple of years, and let's say the net income of the company was $200,000, but you only took $100,000 home, some of our lenders can use a percentage of that extra 100 grand that you left inside the company as income. And so that might help you qualify for more. It doesn't necessarily mean that you would want to buy that in the company name, however, and that's a completely different conversation, and probably one that I could fill an entire webinar with, which is, should I buy my rental properties in a holding company name, or should I buy it in a personal name? And that's a bit more complex. But long story short, if you're looking at figuring out if you should buy in a company name or a personal name, it usually comes down to where your down payment source is coming from. If you have money for the down payment that's inside of a corporate structure, it often makes sense to buy real estate in a holding company. The income on the tax on income inside a holding company is usually higher than a personal tax rate, but you're investing pre-tax dollars, because if your money is inside of a company right now, instead of you having to take that money home and pay personal income tax on it and then have less money left over to invest, instead you can invest pre-tax dollars for your down payment. You'll pay more on the income side of things over time, but you're essentially kicking the can further down the road by buying in a company name. But again, that's a really it's a long process to discuss whether you should be buying in a company name or a personal name. And then again, that's something where we usually get the accountant involved to give some advice on that too. But usually looking at somebody's situation, we can usually give somebody some advice on whether they should do it in a personal or a company name. Riley has a question. Can you check your credit score for free with an app like Credit Karma or Borrowwell? Yes, you can. When it comes to applying with a creditor, however, so if you apply with us, we do have to have a credit bureau in order to submit to any lenders because they will not take your inquiry that you have. But if you just want to get a quick idea of what your credit score is, you can use Credit Karma or Borrowwell, or your banks often have an app located in them. One word of caution, and I don't know why this happens or why they do this. A creditor report is slightly different than a consumer report. When you go to pull your own credit rating, it often is anywhere from 10 to 50 points higher than what a creditor will see. And I don't know why it's not transparent and they don't just give you the exact same report when you go to check it yourself versus a creditor. But just note that the credit rating is often the same or more likely to be higher on your end than it is when a lender pulls your credit. Shahela has a question. If you put your HELOC in your company and then use it to invest, would the interest still be tax deductible? So this is where things get a bit tricky. If the HELOC is in your company name, then it's likely that all of that money is already tax deductible anyways on that property. So really, it's the purpose of the funds and where you're pointing it to. In general, the Smith Manoeuvre, a lot of these things that we've talked about, usually is most relevant when you're dealing with your primary residence and how to turn your primary residence from being not tax deductible to being tax deductible. So depends on the situation, but you'd have to making sure you understand, where the money is borrowed if it's in the company name, but also what the purpose of the funds is for. So if you're using it to invest in earning income in that. So it probably already is tax deductible if the mortgage is in your company name already. One more question. If you have a sizable investment portfolio in equities, does the lender consider this against the loan that you are seeking? Yeah, this is an interesting one. So you do need to consider this because the consideration here is, what are they looking at? Are they looking at your net worth, or are they looking at your income? If you have a large stock portfolio and you've borrowed a lot of money against that, usually you can get between, if it's all blue chip stocks, 50, maybe as high as 70% sometimes leverage against your blue chip stocks, usually at like prime or prime plus one. The concern is that if that debt is reporting on your personal credit bureau, it will negatively impact your debt servicing. And so if you have a margin account attached to those or anything like that reports to the credit bureau, then that's going to negatively impact your ability to qualify. On the flip side, there are some net worth programs where maybe if your income and your debt servicing is now poor because maybe your income isn't good or not high enough, and on top of that, you've got a massive line of credit that's reporting because it was secured by those stocks that you have and used to invest, you may be able to qualify for a net worth program instead. But it depends, again, if those equities are held in a margin account or not. But there are some programs you might get up to 65 or even 80% leverage buying a residence, or some lenders will consider rental properties. Not most of them, though. Most only do owner-occupied homes under the net worth programs. But there may be a net worth program you can get 65 to 80% of the financing, depending on the size of your portfolio and what your income actually is. So there are some options there. So the credit rating for each bank is not accurate. I checked mine from online banking, so not always accurate, Todd. So sometimes your score might be 10 to 50 points higher. So you just have to be mindful of that. So where can you access this net worth program? Myself, we have access to different lenders, and different lenders have different net worth types of programs. And so if you want to learn more about it, we'd be happy to assist you with that. Every lender has different thresholds and different programs. Some of them require a minimum of $250,000. Some of them have a minimum of $500,000, and then they have a lot of underwriting policies that are quite complex to look into. So it's not that difficult for us to assess your situation from a high level. If you want to send us an email and say, hey, this is my situation, this is my income, this is the size of the portfolio, these are the debts that are reported on my personal credit bureau, and this is what I wanted to be doing, then we can give you a high level either over the email or set up a quick phone call just to assess it. You don't want to waste your time, and we don't want to waste ours going, diving deep and gathering a bunch of documents just to figure out what that might look like. Is the credit rating on Equifax accurate? So yes and no. So if you're asking if you pull your own score from Equifax, is it accurate? Not always. Sometimes the score that you pull could be 10 to 50 points higher than when you look at it versus when I pull it. And we've had it where a customer pulls their own credit, I pull it the same day, or we pull it the same day, and the score that we have is much lower than the score that the customer has, which again, it just doesn't make a lot of sense. I don't know why Equifax does that, but it is how it works. So we all have to live with it. And what I'll do now is, I don't see any other Q&As. I'm going to quickly review and see if there's any other questions that popped up in the chat, just to make sure that we've addressed those. And then if that's it, then we can wrap up. So let me just take a quick look. Let's see here. There's a question of TD or HSBC do readvanceable mortgage. TDs is readvanceable. HSBC, not quite. They register it like that, but the line of credit is static, and so it's not quite as good as TD's product. So HSBC has really good rates. Services, leaves a little bit on the table on the service department, I find. But their rates are more competitive than most other lenders right now, so it's something to consider. Let's see here. Any other questions? Shaheen asks, once your entire mortgage is converted into a line of credit, would it then make sense to convert it back into a mortgage to take advantage of the lower rate? Often, yes. And in fact, you don't always even have to do that at the very end. You can do that if you invest in blocks. If you say you're going to borrow the 100 grand and invest it, you can then lock in that 100 grand portion into its own mortgage portion. Also makes it easier to track if you now have it converted into its own portions. Let's see here. Any other questions? Let's see here. Simon had a comment. I heard TD offers as a collateral charge, not a product you want, as it registers 125% charge in your purchase price. Look elsewhere for a more favorable product for you. So on the collateral charge, I'll make a quick note on that. It's an interesting one because there's a pro and a con to it. They register more on the title than what you actually owe, but that's not the amount that reports on your credit bureau or anything like that. But the reason that TD does it, in essence, it makes it easier for you to stay with TD, harder for you to leave them. That's what it comes down to. Because when the renewal comes up, it's hard to do what's called the transfer out of TD without having a new lawyer have to re-register all the mortgage documentation. On top of that too, if you default on any other credit and you have a collateral charge, then the bank can actually foreclose on your home because you stop making mortgage or stop making credit card payments on your credit card. And so that is a downside. On the flip side, the pro is that in the future, if you wanted to refinance and borrow more money against your mortgage with TD, then you can do that up to the amount that they registered on the title, which would have been 125% of the purchase price, without having to see a notary or lawyer. So again, it's easier to stick with TD, harder to leave them in general. All right, any other questions? Let's see here. Jessica, I see that you've put an address here in the chat. Just if you could send us an email to info@greenmortgageteam.ca, and then that way my assistant can handle the books. So if you would like a copy of the book, email info@greenmortgageteam.ca. Also, I see Kate, who's one of our account managers on our team here, also said that you can email her as well, and she'd be happy to assist you with that too. Ian is mentioning, are running into banks not wanting to do mortgages on investment properties that are being Airbnb? So I did address that, and yes, it is more difficult to get financing on Airbnbs. But have no fear, I am doing a presentation in a couple of months all about financing Airbnbs. Let's see here. Just going to see if there's any other questions that I haven't answered yet. One question is, can you refinance your home and take out that extra cash and use that for investment and write it off as well? Or you can only do that with the HELOC. You can also refinance your home. You can do that. It just gets more complicated because if you do it in one bulk and bundle on the mortgage, now you have to do separate amortization schedules for each, because if you had a $500,000 mortgage and 100 grand of the money went to investing and the other 400 was your personal non-tax deductible portion, it gets a lot harder to be able to track what portion was tax deductible and what portion was not. And your accountant has to do a new amortization table every single year. So it's not advisable to do that, but it is possible still. You can still exemplify that you borrowed the money to invest. Let's see here. Emad said, I did ask 2 more questions. Please check. I'm just going to take a look here. Oh, here we go. So can you get condos for the 50 to 130 grand range? You can, yeah. There are properties across Canada that can be quite cheap. I'm sure you can find a condo in a small town in Saskatchewan or Manitoba or the Maritimes or something like that in the 50 grand range. And there are ways to do that. But the problem is that if you look at why it's 50 grand, there often are reasons that it is so cheap. And sometimes it could be a really bad area or a really bad building or whatever the case may be. And so just because it's cheap doesn't mean it's good. That's really what it comes down to. Overall, when you're investing in real estate, you're always looking at your projected return on investment, how much money you're going to make in this investment. And I found that sometimes the small deals can be really good, but often the bigger deals are often where the better money is. And so sometimes, yes, maybe it's a restriction where you just don't have enough cash or capital to do a bigger deal. And maybe if you're restricted on the cash, then maybe it's a matter of just trying to figure out how you can get more cash. Maybe you do a joint venture and bring in another person, bring in family, parents, friends, or whatever, do an official joint venture, team up together, and then buy a slightly bigger property, one that will generate a higher return for everybody by buying in a better area and a better market. So the answer, yes, you can find condos in the 50 to 130 grand range, but I don't always necessarily recommend that. Another question here is, I attended a seminar where they said there are ways to boost your line 150 income. Is this possible? I mean, it really just comes down to how you file your taxes, and there are ways that you can file your taxes and claim a higher income if you and your accountant decide to do that. So that's something that you'd have to discuss with your accountant. Reba is asking as well, do I recommend variable or fixed rate? In general, we are recommending variable right now. 3 primary reasons. Number 1, the interest rates right now are cheaper for variable. You're looking at about 1.5%, whereas fixed are anywhere from 2.5% to 3% right now. So there's a big gap between the variable and fixed. Number 2, the variable can be locked into a fixed rate at any point in time. So you can convert it from a variable to a fixed if it looks like rates are starting to climb, which we do expect likely to be this year. It's not for sure etched in stone, but we do expect that fixed rates will probably start to increase again later this year, like Q2 or Q3. Third item here, which is probably the most important one, however, is for flexibility reasons. And so the penalty to break a variable rate mortgage is 3 months interest. The penalty to break a 5-year fixed rate mortgage with a major bank in particular is either 3 months interest or what's called an interest rate differential penalty. And this penalty is the difference between your rate and current market rates for this remainder of the term. The way that banks manipulate posted rates means that these penalties often are way more expensive than they should be. Without going into a really long, drawn out explanation about it, the penalties to break a 5-year fixed rate mortgage are in general about 5 to 10 times more expensive today than it would be if you were in a variable rate mortgage. And here's the thing. We've had a lot of people ask this. I bought a property 8 months ago. Should I refinance? I bought a property 2 years ago. Should I refinance? If you bought a property, went into a 5-year fixed rate contract with a major bank, and you wanted to then break that mortgage and redo it because the value has gone up. Let's say that you bought another rental property, another bank that you set up your residence with. Now all of a sudden their bank says, well, now you've got the rental, your debt servicing doesn't work. But another bank, maybe Green Mortgage, can source a different lender for you. Now we find a different lender, but you're going to pay a penalty to break that mortgage. Now all of a sudden, if you have a $30,000 penalty to break the mortgage instead of a $3,000 penalty, well, that flexibility to be able to move around and access more capital is very relevant. And one thing that I always find is when investors are starting off, they're still very rate sensitive and rate focused, because when you bought your primary residence, that was usually the most important thing to you. As you start to build a real estate portfolio, access to capital becomes more and more important, and the rate becomes less important. 0.1% or 0.2% here and there become less relevant versus, hey, can I get 80% financing or only 65% financing with the bank? Because that difference is going to be the difference between me being able to buy 2 rental properties this year or only 1. And I'll make a lot more money if I can buy 2 rentals than if I can only buy 1. So in general, access to capital is easier if your penalties are cheaper. And so that's why for most of our investors, we do recommend variable rates in general. I have another question from Sean here. If I need to reapply for a mortgage, how much impact does cash on hand have? My situation, to explain why I'm focusing on reapplying is I have a guarantor, but in the future, I would like to remove them in hopes of being able to take on the mortgage alone. If it's told if I remove her, I need to reapply for a new mortgage. So yes, anytime that you have a guarantor on an application, if you're going to remove that person, you have to stand on your own and prove to the bank that you can stand on your own 2 legs. And so that is something that you'd have to do. Sometimes if if the timing is right, it often makes sense. If you wanted to look at doing a Smith maneuver, you would look at, hey, can I qualify to do this on my own and get a Smith maneuver type of product at the same time? Is something that it's good to just lump things together and do it all at once. I'm not going to sit here and sugarcoat it. Getting a mortgage isn't the most fun thing to do. Most people don't choose, you know what? I'm kind of bored. I think I'm going to do a mortgage right now. It's a means to an end. Let's put it that way. It's a means to saving money or earning a higher rate of return, however you want to look at it. And so in general, I would say that you try and lump those things together. Awesome. I think that answers all of the questions. And yes, Erica, definitely reach out to us and we'll be happy to book a call and answer your questions. Thanks so much for attending, guys. This is a well-attended event. I think I checked at some point during the middle of the presentation. I think it's about 150 people here, which is awesome. So it seems like everybody's hunkering down, gathering around the fireplace, finishing off that Baileys that they have left over in their fridge from Christmas. And I'm really glad to see a lot of familiar names and whatnot here at the webinar. So looking forward to seeing you at the next one. And thanks so much. Have a great night.